recession and depression. The United States economic landscape has been shaped by the waves of these two for so long, from the devastating flows of the Great Depression to the tremors of recent recessions. Exploring the causes and consequences brought about by both recession and depression within a nation is crucial for extracting valuable lessons to safeguard its citizens and economy if and when the next one rolls in. When overlooked and handled lightly, both can escalate onto the world stage. Oftentimes interchangeable by many, recession and depression are different in some ways and similar in others. In the U.S., the National Bureau of Economic Research sets the official definition of a recession. They describe it as a significant downturn in the economy that lasts more than a few months and impacts various sectors. According to Forbes Advisor, the key signs of a recession include rising unemployment as companies lay off workers due to lower demand, and a drop in home sales and prices because people are less willing to spend on big purchases. The stock market also tends to fall, reflecting investors' lack of confidence in the economy and companies' ability to make profits. Wages often stagnate or decrease as businesses try to reduce costs. All these factors lead to a decrease in consumer spending, which in turn causes the gross domestic product or GDP to shrink. Though often with a negative connotation, recessions are a natural part of the economic cycle, and since World War II, there have been 13 of them in the US until 2022. A depression, on the other hand, is a severe and prolonged economic downturn that can impact multiple countries all at once. During a depression, unemployment rates soar into the double digits and remain high for years, drastically reducing consumer demand. The Great Depression is a prime example of this, lasting from 1929 to 1939 and causing widespread devastation. Forbes Advisor says that in the U.S. during the Great Depression, unemployment reached nearly 25%, leaving around 12.8 million people jobless. Wages plummeted, with earnings dropping by 42.5% from 1929 to 1933. Real GDP also suffered, decreasing by 29% in the same period. Additionally, the banking system saw widespread failures, with about 7,000 banks, nearly a third of the total, collapsing between 1930 and 1933. Contrary to many worries, Forbes believes the U.S. is far from experiencing another depression, because several measures have been implemented to prevent such an event. Nowadays, the Federal Reserve actively manages the economy to prevent crises. While during the Great Depression, the Federal Reserve didn't act to control the money supply and prices, leading to deflation. The government has also established safety nets like unemployment benefits and stimulus checks. The banking system is also much stronger today, with the Federal Deposit Insurance Corporation, or FDIC, insuring deposits up to $250,000. Additionally, the Dodd-Frank Act, enacted in 2010, reformed the financial system to enhance transparency and accountability, making it more resilient. But that's for another economic depression. What does the future look like for the U.S. when it comes to recessions? According to the Bureau of Economic Analysis, in the first half of 2022, the country experienced a mild economic decline. The economy shrank by 1.6% in the first quarter and improved slightly, but still fell by 0.6% in the second quarter due to reduced inventory spending, housing investments, and government spending. However, they also estimate that in the first quarter of 2024, the economy grew at an annual rate of 1.6%. Additionally, as cited by the American finance company NerdWallet, the Federal Reserve did not aim to cause a recession but wanted to slow down the economy. After raising interest rates 7 times in 2022 and 4 times in 2023, they paused in June 2023, seeing some signs of inflation easing but cautioned about more rate hikes to come. As warned on July 26, 2023, rates increased by a quarter point. The Federal Reserve kept rates steady in September, November, and December 2023, and again in January, March, and May of this year. The goal is to reduce consumer demand to counteract rising prices caused by inflation, but there's a risk of recession as a possible side effect. A Business Insider article released on April 29, 2024, says that the U.S. is already in the midst of a recession. According to Danielle DiMartino Booth, a seasoned forecaster, the U.S. economy is currently in a decline, and it might be mirroring China's situation as the government takes on more debt to boost growth. Booth, the chief strategist at QI Research, has been saying for months that the U.S. is already in a recession. She points to the weakening job market as evidence, citing recent downward adjustments in monthly job growth numbers. However, she notes that by historical standards, the job market is still strong. In March, the economy added more jobs than expected, at 303,000, while the unemployment rate remained close to a record low. However, the number of new jobs created was slightly adjusted downward for February, dropping to just 270,000. At the same time, layoffs and unemployment have crept up in recent months, with total job losses reaching millions in February, according to the Bureau of Labor Statistics. Booth commented in a recent interview with Fox Business, "These revisions, they keep pushing us back further and further from where we thought we were. It seems like every time companies report their earnings, they're doing it with a kicker that says, hey, we're going to lay off 2,000 people or 1,500 people or whatever it is." Booth had previously mentioned that layoffs could increase from 150,000 to 370,000 by the end of the year. Booth noted that the economy is already having difficulties, particularly in light of the U.S.'s rising debt levels. She made the comparison to China, where government debt has increased dramatically. According to FactSet estimates from 2019, state-owned firms accounted for around 60% of China's GDP. The federal debt has hit a record high of $34.5 trillion, according to Treasury Department figures. Experts have cautioned that rising debt levels may cause the economy to suffer from a number of problems, including increased inflation, increased market volatility, and a decline in the standard of life for Americans. According to the School of Advanced International Studies in Johns Hopkins University, the surge in inflation that hit the U.S. can be linked back to the COVID-19 pandemic. In 2020, the U.S. decided to print about 1/5 of all the money in circulation, around $3.3 trillion in total. This aimed to encourage borrowing and inject cash into the financial systems. The Federal Open Market Committee also made 2 interest rate cuts, bringing the federal funds rate down to a range of 0% to 0.25%. This boosted spending weakened the value of the dollar, leading to inflation. As cited by CNBC, in June 2022, the U.S. saw its highest inflation rate in 41 years, hitting 9.1%. Although inflation rates have since dropped, consumers are still feeling the pinch, with a 3.7% increase in the Consumer Price Index from September 2022 to September 2023. This is mainly due to shrinking household incomes and supply chain problems. Most of the stimulus money given to citizens during the crisis has dried up, saying that the least wealthy 80% of Americans have less money on hand than before the pandemic. Among younger Americans, credit card debts have been rising non-stop since the end of 2021, indicating a shortage of available funds. Additionally, debt rates surged by almost 5% in the third quarter of 2023 compared to the previous quarter, suggesting that banks are taking on too many risky loans. And it isn't just national debt and inflation. Numerous companies are starting to lay off workers as they switch to using AI for tasks. This will cause a big rise in unemployment for a while, until the job market changes and finds new ways to hire people. According to the Pew Research Center in 2022, about 19% of American workers had jobs that are most likely to be affected by AI. That means AI could either replace or help with the most important tasks in those jobs. In addition to domestic unemployment, the U.S. is suffering from slowing global economies. China, one of the largest trading partners of the United States, is experiencing a severe slump in its economy, primarily as a result of its real estate issues. With a 21% youth unemployment rate, the job market in the U.S. will be impacted by China's economic slowdown. Concerns about the unpredictable nature of Chinese supply chains and production are common among U.S. enterprises. Uncertainties in the domestic and global economies will cause businesses to tremble. With this far into the video, it's important for us to have an understanding of the Great Depression and what it took for the country to crawl its way out of it. So let's take a trip back to the time of the crisis. An international economic crisis known as the Great Depression began in 1929 and continued until around 1939. It was the longest and worst depression to ever hit Western nations, and as a result, significant adjustments were made to economic theories, legislation, and management practices. Despite starting in the U.S., it had a significant negative impact on manufacturing, widespread unemployment, and severe deflation in nearly every nation. It had a profound effect on society and culture, particularly in the U.S. One of the biggest financial crises of the 20th century, the Great Depression, continues to be used as the standard by which recessions are measured. For a great many Americans, the federal government's response to a significant national emergency is still modeled after President Franklin D. Roosevelt's New Deal. By the late 1940s, the country had emerged from economic catastrophe into an unprecedented era of national prosperity marked by a substantial rise in income equality. Today, a lot of people aspire to make the New Deal's success their own, but the spirit of individuals who worked tirelessly to make it happen was just as important to its success as the numerous organizations and initiatives it established. Through vigorous federal intervention, the New Deal sought to accelerate economic recovery and put Americans back to work. In order to regulate agricultural output, maintain price and wage stability, and start a sizable public works program to aid the unemployed, new federal agencies were established. The New Deal was not a rigidly ideological program, but rather a sequence of trial and error measures. The president and his advisors lacked a well-defined long-term strategy. Rather, in the first 100 days of the administration, a plethora of legislation and regulations were passed. Programs that functioned were kept in place. Those that didn't were replaced or discarded. For instance, the National Industrial Recovery Act was deemed unconstitutional after failing to achieve its goals of encouraging collective bargaining and establishing fair competition rules for salaries and prices. In response, the administration moved swiftly to enact a new law. Social Security, unemployment insurance, and public housing were among the welfare initiatives of the New Deal that didn't completely take off until after 1935. Numerous attempts failed, one of which was the early termination of federal programs, which resulted in the 1937 Roosevelt recession and a substantial increase in unemployment. The world had undergone tremendous transformation by 1936, when Roosevelt was elected to a second term. Federal work and relief programs developed by New Deal agencies were helping a lot of individuals in need. Roosevelt won over Americans by attending to their needs. In the midst of the hardships posed by the Great Depression, Americans from the working class cast record numbers of ballots and selected the Democratic candidate for president. It was the enormous economic boost from the war that ultimately pulled the United States out of the Depression, though the war also brought more years of misery and sacrifice. Despite the New Deal's efforts, unemployment remained high just prior to World War II. It took encouragement for many Americans to accept a post-war era that heavily depended on consumer spending to bring about widespread prosperity, as many had never entirely recovered from the trauma of the Depression. In recent times, a multitude of Americans have lost their employment since the coronavirus struck, leading experts to draw comparisons between the current state of affairs and the Great Depression. It's difficult to predict the kind of recovery following COVID-19 shutdowns. The plans and tactics employed in the 1930s will not be the same as those in the modern day. Nowadays, increasing consumer spending, which accounts for about 70% of GDP, takes priority above job creation in the minds of policymakers. Leaders frequently choose to provide financial aid to the unemployed instead of creating new jobs. Stores and restaurants, who are already having difficulty competing with online businesses, have been particularly heavily struck. Their sluggish recovery has negative effects on public life, in addition to the economy as a whole. Reflecting on the Great Depression reminds us of how deeply it affected society. This significant period of history offers multiple important lessons for many of our authorities today. According to New Trader U, diversification is crucial. Relying too much on one industry or sector like the stock market and manufacturing in the 1920s can lead to disaster. To prevent future crises, it is vital to embrace economic diversity. By promoting a balanced economic landscape, we can ensure long-term stability and growth. In 2023, the U.S. economy heavily revolved around the stock market, with many invested in retirement accounts like 401ks. This focus on boosting the stock market has sometimes overshadowed the need to let market forces naturally regulate share prices based on earnings. Similarly, real estate prices have been overly relied upon to increase net worth, especially in the early 2000s and again after 2018. They also put an emphasis on sensible lending and borrowing. Financial catastrophes, such as the Great Depression, can result from careless lending and excessive debt. Due to the fact that high levels of debt contributed significantly to the Depression, it is crucial that banks and investors exercise caution when taking on new loans. Although lending methods then and now are still alike somehow, it's crucial to remember that significant limitations and adjustments have been implemented to prevent repeated calamities. However, examining the commonalities can provide helpful hints regarding potential risks and vulnerabilities inside the financial system. To put things into perspective, during the Depression, many people suffered because of the debt they had. After World War I, the U.S. economy was booming, and getting loans became easy for the first time. Regular folks started borrowing money to buy things like fridges and radios. They also borrowed to invest in the stock market, known as buying on margin. So, when the Depression hit, numerous people struggled to pay back what they owed, while those who didn't have much debt were better able to cope. After the Great Depression, a significant amount of people were cautious about getting into debt for a long time. Another way for the country to safeguard its economy during times of economic crisis is to get central banks heavily involved. In times of disaster, central banks are essential to maintaining the stability of the financial system and the economy. The Great Depression worsened as a result of the Federal Reserve's slow response to maintain monetary stability and stop banks from failing. In order to lessen economic loss and promote recovery, central banks now must take the initiative to maintain monetary stability during crises. People's bank balances are safeguarded by fresh bailouts from governments and central banks, but banks are also encouraged to take on excessive risk. Because of all the money required for bailouts, this could devalue the US dollar and produce inflation. Relying on the government to stabilize the country's economy is one thing. Safeguarding ourselves from such a dip in the economy is another. So no matter what time in history we are living in, one must be responsible for responding to the nation's current financial crisis. All working people can agree on one thing: put money aside for emergencies. Following World War I, the U.S. had the wealthy Roaring '20s before the Great Depression struck, taking most Americans by surprise. Individuals without money ended up bankrupt, jobless, and/or in debt. One important lesson from the Great Depression is that planning ahead proves helpful since unforeseen events can happen. It is never too late to begin saving for an emergency fund, even if you are concerned about increasing unemployment. In a high-interest savings account, the earlier you start saving, the more money you'll have when you need it most. Another thing to learn is how to minimize debt. Many people fell into poverty during the Great Depression as a consequence of taking out store credit and borrowing money for goods during the 1920s. As a result, these borrowers were left with a mountain of debt and no ability to pay it off when the stock market plummeted and layoffs started. And debt isn't a generational or seasonal problem. It still is a major issue today. Despite the fact that many have been delaying credit card payments during the pandemic, they are only piling up more debt. It can be said that it's wiser to pay your financial obligations as quickly as you can to avoid making the same mistakes that were made during the Great Depression. To cut interest costs, lower monthly payments, and reach debt freedom sooner, you might want to think about taking out a debt consolidation loan. Yahoo Finance offers a litany of practical ways one can be smart with their money, learning from the economic tragedy that is the Great Depression and unprecedented events like the COVID-19 pandemic. From the advantages of relocating to family insurances. With the world being unpredictable as ever, and the U.S. slowly making its way into another recession, it is vital for one to be equipped with the right tools and a smart mindset. From the biggest dip of the Great Depression to cyclical recessions, stories of perseverance, innovation, and renewal rise. With another recession approaching, policymakers and people of authority need to tread carefully during these times. But it is also crucial for citizens to uphold responsibility and safeguard themselves for when it happens. Thank you for watching.